This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show.
Gary, welcome. Welcome to Advisor 3.0. It's great to have you here with us. Gary has spent more than 25 years in the industry across research, asset selection, asset servicing, and he works very closely with Northern Trust teams across equities, fixed income, multi-asset, and the alternatives, I believe. So he's got great insight into how large institutional clients are thinking at the moment, what's driving the portfolio positioning. So we're going to cover a fair bit of ground, get Gary's thoughts on the current macro picture, what's going on out there in the world, but our aim throughout is to think about how this can translate into the conversations that you as advisors are having with your clients at the moment. So we very much want to put it into that context that will reach the underlying retail consumer. As Matt mentioned, we have Slido. Please feel free to ask any questions as we go along, and also we'll leave some time at the end. So whatever works best with the flow. So Gary, thanks very much for joining us. I thought before we dive into the bigger picture, it would be great for everyone to hear a little bit about your background, what brought you here to the role of investment strategist that you've got.
Sure. Well, thank you, Nicki, and thank you for the invitation. A little bit of background. I'm a Kiwi. Before anyone makes the fatal mistake of thinking I'm Australian, I've lived in this country for 26 years. I had a background as a rugby player and then as a legal barrister for a very short period of time. Came here to study, started working as an investment banker, and then I set up my own thematic research brokerage. Put a pin in the themes piece because that's, I think we might come back to that later. I sold that business to Northern Trust, and then more recently I moved to Northern Trust Asset Management, where I'm now our investment strategist here in Europe, which means I spend time with our investment committee thinking through our strategic and tactical asset allocation. But principally I spend time with clients like you guys, trying to figure out where we should be allocating our capital and perhaps where we should avoid. I'll give this little story because I think it sort of adds context to the environment we're in. Now, the story is, if you were to mark my life, my career, chart my career as a stock chart, you would notice that every big move I've made has coincided with a large market top. So the week I landed in the UK, it was the same day, September 18, 1998, that the Russian debt crisis, just before LTCM. My first task as an intern working for Merrill Lynch was to research a company called Pets.com, which was known as the company that burst the then dot-com bubble. My first day on the job as a full-time employee in New York, downtown Manhattan, attached to the World Trade Center by a footbridge, was on 9/11. Our first trade when we set up Aviate Global was July 17, 2007, 13 minutes from the top tick in the Euro Stoxx, just before the GFC. We sold the business just before Brexit, and I moved across to NTAM on Liberation Day last year. So that's the bad news. I'm a really, really bad omen. The good news is I'm not leaving, and I'm here to stay for the time being anyway. But I jest, but there is a serious underlying message, and that is not all things necessarily need to be bad, right? There are a lot of good outcomes in the range of possibilities. So I just, as a starting point, I think that's always worthwhile just bearing in mind.
Yeah, 100%. And good to know that you're a leading economic indicator as well.
I will call if my next move, I'll let you know.
Yeah, let us know.
Yeah.
So do you think that these experiences and seeing that crises kind of happen throughout our careers while capital markets just continue to go on and do their thing, has that shaped how you make decisions within the investment universe? What kind of impact has that had on your own behaviours?
Huge. Sort of the lessons are, avoid the pessimists, I think. Morgan Housel was here this morning talking about, he's got a great chapter in his book called The Seduction of Pessimism. I think just being aware of those things is really relevant. We all have a negativity bias. It's a human instinct.
Yeah.
And I think it's important we challenge some of those biases. But look, as you say, I mean, I've been through several what I thought at the time were career-ending crises. I thought 9/11 was it. I thought the GFC was it. And yet here we are at all-time highs. And so, what's the lesson? I often refer to Alroy Dimson, who I think you know, Nicki.
Mm-hmm.
He was the professor at my alma mater. And he's got this great quote about, what risk is. And risk is means more things can happen than will happen. And what I think he means by that is risk is the gap between what we can see and measure and what we can't see or imagine.
Yeah.
We can all see the jobs or tasks that are going to be disrupted by AI.
Mm-hmm.
We can all see what's going to happen to inflation with disruption in the Straits of Hormuz.
Mm.
We can't yet really see what new jobs are going to be created from AI. We can't really see what, good outcomes come from, I don't want to call it peace, but more normalized relations in the Middle East. Something, by the way, that the Israeli stock market and, interestingly, the Omani stock market have been suggesting throughout this entire conflict. The Oman stock market's up 40% year to date. It's one of the best performing markets in the world. And stock markets live in the future. And they're telling us a story of the future that perhaps many struck by headlines don't want to think about. So I think it's really important that in a world where uncertainty is so high, the range of potential outcomes is so vast that we need to acknowledge that not all outcomes are going to be bad, but we also need to consider what good outcomes could come from them.
Yeah, 100%. My first subject was psychology, and you're absolutely right. Human beings are programmed for survivorship bias, and that's avoiding the threats and the risks. So we're tuned in.
Yeah,
that's what our brains are looking for constantly, the threats, which can be overwhelming for clients when they're looking at their investment portfolios, thinking about their savings, and exposed to all the news and the bad stories that we are now in the media. But a timeline, we often talk about market corrections being inevitable. They're a feature. They're not a bug. To quote Abraham, and it sounds like something that you'd be on board with, that we have to accept as part of being in the game. Really,
100%. I mean, Abraham's comment and I guess your philosophy is shared by some of the greatest investors. My hero when I was coming into this game was Peter Lynch, who wrote One Up on Wall Street, which is just a brilliant book. And he always talked about if you sell in desperation, you always sell cheaply. Mm-hmm. He said, to master the market, you first need to master your emotions. Yeah. And Buffett goes on about, the stock market is simply a device for transferring money from the impatient to the patient investor. So I think for anyone with a long-term view or someone that's very patient, who can sort of look through some of the emotive aspects of markets, corrections are a feature. Corrections are welcomed. This is an opportunity for them to buy things on sale, to use Buffett's term. There's a great book by Jason Zweig, the Wall Street Journal editor, and he wrote a book called Your Money in Your Brain, which interestingly was released, the paperback version was released the same day Lehman Brothers went under. So if you didn't read it, there's good reason why not. But I think that curious timing. And he showed that the part of the brain that processes losses, with investment losses, is the same part of the brain that deals with mortal danger. So when that snake comes into the cave and you have a fight or a flight response, it's your amygdala. And your amygdala gets hijacked and you fight or flight. And triggers reaction, right? You want to sell, fight, that's flight. And I always think of that when I'm triggered. And I do get triggered, when things are down and you think, oh, this, and you want to sell. But there's that wonderful stat, if you missed out on the 10 best days in markets over the past 20 years, you've halved your return.
Yeah.
And so I think that is just really important to, when we're faced with all of this, and it's a deluge, right? It's a fire hose of information, especially if you're a social media user. And you've got these tweets, and you've got, Donald Trump tweeting and truths, and it's a bombardment. And I think it's really important that you try and look through that, go back to the process, the data, the fundamentals, and not just try and figure out what might go wrong, but really focus on what might also go right.
Yeah. Stick to the plan.
Stick to the plan.
Yeah. So as you've alluded to, we are in a very complex environment at the moment, there's more going on than average geopolitically, alongside the bombardment of information. We've got conflict, we've got Donald Trump, we've got a change at the Fed's inflationary environment continuing. What do you think are the key things that are driving portfolio decisions at the moment?
I think it's changed a lot over the years. When I first started, we used to get all excited. I'd be sitting on the desk at Merrill Lynch, and we'd all look forward to Friday because you'd have non-farm payrolls would come out at 1:30 on a Friday, and we'd all quickly react. We all knew what to do. If they were hot, you buy cyclicals. You sell bond proxies. If they were cold, you do the opposite. It was pretty simple. But that game's changed, and I think it's changed in a way that it's really important now to have at least if not an overlay, have an understanding of the way thematics impact price. And by thematics, I mean these big mega forces, which tend to orientate around demographics or technology or geopolitics. And the reason I think is so important to think about is these big mega drivers, mega forces, not only are challenging some of the assumptions we all used to hold dear to ourselves, but they're at times completely changing or arresting the dominant macro or economic narrative, such that, the best example still, I think, is the same week ChatGPT was launched in October of 2022, Bloomberg ran a survey. 100% of analysts that they surveyed were forecasting recession and for the stock market to be down in the US in 23. Yet AI had different ideas. So having a starting point, or at least an overlay of understanding these themes, is becoming increasingly important. I'll give you one example. Take demographics. So here's the headline. Demographics are the reason we have rising debt and deficits, and therefore dollar debasement. What do I mean by that is aging populations mean more people are retiring than entering the workforce. With rising entitlements and less taxes, governments need to issue debt. Every time you issue debt, you're debasing the currency. So how do you protect yourself from an investor standpoint? You have to buy scarcity, buy scarce assets. But how do you solve that problem? You invest in technology. Because it's technology that's going to deliver the productivity which helps solve those issues. So, and how do we know about technology? Well, you're not going to find that in the non-farm payroll. You're going to find that understanding Google. And I think micro now is macro. You can't have a view on the macro environment unless you understand what Google's doing, what Nvidia's doing, what Tesla's doing. So I think micro is now macro. I just returned from China, and I found it fascinating. In Hong Kong, Hong Kong ports have just bought a whole bunch of robo trucks to work in the ports. And I just assumed that was because the technology is so amazing. Well, the technology is amazing, but the principal reason they invested in these autonomous trucks is because there's no longer any drivers.
Wow.
They're all retiring. The average age is 60, and there's no succession because these young kids coming through, they don't want to work shift work.
They want to drive.
They want to be influencers.
Yeah.
And so I thought that was it. So where you get these confluences of these big mega trends, that's where you want to invest. Or you just buy the US stock market, because that's where most of them are.
Yeah, yeah. But that brings me on to an interesting point. We have many clients at the moment that are concerned about the US stock market, and particularly the size of its allocation within the global market at the moment. What would you be saying to reassure clients about that? Is it a valid concern? Should we be worried about concentration risk right now in these US tech stories?
Well, I think it's perhaps more of a concern if you look in other markets like Korea or Taiwan. As it relates to the US and to the concentration risk, if we call it such, in the US, I'll say three things. The first is it's been a lot higher in the US. And we all look at .com, which was 42%. I think now we're about, I think the .com was about 38%. The top 10 stocks were 38%, mostly tech. Now it's just a wee bit above that. Not dissimilar levels to what we had with oil prices back oil stocks back in the 1982 oil boom. But if you go back to railroads were 63%. So I think that's point one. They've been higher. Point two is if you adjust for the valuations of these previous bubbles, we're quite low. The concentration should be a lot higher. Yeah. So when you look at the concentration in terms of value, let's call it 40%. But the concentration in terms of earnings, future earnings growth, is above 50. So they've been quite demonstrably derated, which you didn't see at the peaks of previous bubbles.
And what do you think's behind that? What's causing those multiples to be?
It's the uncertainty. I think a lot of people, are fearful of that they're overspending, that we're unsure that their software revenues are going to be, sustained into the future. There's question marks about terminal values. I mean, that comes into the question of whether AI is a bubble.
Right.
But going back to the concentration point, probably the most important counter argument to the fear that these are too concentrated is the fact that these, let's call it 7 stocks because that's the vernacular. These 7 stocks, they're not stocks so much as sectors. They're not companies so much as conglomerates. I mean, the Mag 7 in aggregate has bought, don't quote me on the figure, but it's over 800 companies since they've been in existence. Microsoft's bought, over a couple of hundred. Google's got 13 businesses itself that generate more than $1 billion in EBITDA. So these things are vast conglomerates. They're not, it's not 10 companies.
Yeah.
So I think that helps add context and should, I think, be the type of thing that settles concerns for people worried about that concentration risk.
Yeah. Something else that we often think about too is that these stocks are not intrinsically linked to the US economy either. They're global providers of services. It's something like, I think it's an average of 50% domestic revenue. The rest is globally driven.
Yeah, and also, I mean, they are the economy.
Yeah.
I mean, when I started this business, there used to be a saying, stocks are not the market's not the economy. Well, going back to my point about how megatrends can challenge some assumptions, well, I think that assumption now has been challenged.
Yeah.
AI CapEx this year alone could be 2.5% of GDP growth. Sorry, of GDP. Right? That's what we did last year in total.
Yeah.
Now, sure, not all of that will get spent in the US, but a large chunk of it will. So it's a fascinating time.
It is a fascinating time. So would you be an AI bull? Do you think this is a structural shift that's going to benefit the markets?
Absolutely, yeah. Not just markets, but sort of everything. Even fatherhood. What do I tell my children? My children, for Christmas, got a broken motorbike, and were told if they want to ride it, they need to learn how to fix it. Just because I think those skills could be of use going forward.
Yeah.
And joke telling, I think, is the other thing that they need to learn to do because they're terrible joke tellers. But I think storytelling, that human engagement thing is really important. But so my view on AI is, people go, is it a bubble? And I mean, there's one, there's sort of 5 things people look at to say, well, look, it's a bubble. They go concentration risk, which we've touched, the overspending You know, there's no ROI. That's a big thing. Circular finance. It's a bubble.
Yeah.
Leverage. There's leverage. And euphoria. There's euphoria. Well, let's start in reverse order. Euphoria. I mean, the fact that we're asking whether it's a bubble, I'm not sure if that's euphoric. I mean, if you look at, and you need euphoria and you need hot air for a bubble. You need hot air for a bubble to burst. John Templeton's great quote that bull markets begin in pessimism, grow on skepticism, mature on optimism, and die on euphoria. Where are we on that scale? We're certainly not up here.
Yeah.
I think we're somewhere in there.
Yeah.
And I look at my own experience when I started. As I said, my first gig was researching pets.com. I was a grad, equity research guy. I didn't even know what equities were, and yet I had 3 banks trying to bid for me. So, grads bid only. That's always a sign of a market top. I had people leaving, going and setting up .com businesses, becoming paper millionaires. The head of HR used to fly on Concorde from New York to London to give people pay rises. And the clear sign it was a bubble was my mother used to call me with stock tips. Which, and then it burst.
Yeah, I remember these times. I remember we'd get new carpet laid in the office when the CEO was coming over from Chicago, just so that he had a clean floor to walk on. Yeah.
It was just...
it was nuts.
And Merrill Lynch got rid of their strategist, Charles Clough, like one of the greatest strategists of all time, because he was bearish on tech stocks in '99.
Yeah.
And then, of course, it all burst along with, hopes and dreams of early retirement. But I just don't get that sense of euphoria. The fact that we're sitting here and one of the top questions on all my clients' minds is AI a bubble tells me we're something else. Just to finish on the overspending piece, because I think that's a lot of people go, we're overspending, we're never going to get a return on all this investment, which is what happened back in 2000. They did get a return, but it took 10 years. And unless you've got similar matching profile on your debt, or you need cash flow, and you've got leverage, you've got a problem, which is what happened back then. The overspending thing, on any traditional metric, if you look at CapEx as a percentage of GDP, revenues or cash flow, is demonstrably lower than what it was in 2000. Not only that, every dollar of CapEx is now backed by at least $1 of order backlog. And by the way, the order backlogs are growing faster than what the CapEx is. And some of the customers of these hyperscalers are the fastest growing companies we've ever seen. I mean, Anthropic annualized in December last year, top line of $9 billion. It's just done $44 billion in April. It's going to be 100. That's 10x. We've never seen anything like this. So I think the concerns about overspending ROI are a bit overdone. I don't think they're as big a concern as what they are. But I think the lack of euphoria, the fact that there is a return for the current spending, and by the way, penetration rates. I mean, I read something recently. The percentage of people in US households who currently pay for an LLM is less than 3% of households, which to me is like having a Ferrari but only using it in reverse. Right? So there's all that to come. What's mobile phone penetration? 90?
Yeah.
Probably it's probably over 100, to be honest, because some people own more than one phone. But so I think this is early, and we've got a long way to go.
Yeah, and I know something else you've looked at as well in terms of the impact on the overall market of this structural shift is it's not just what we used to call the tech sector that's growing as a result of this. There's much wider impact for commodities and other areas too.
Yeah, it's a general purpose technology. I mean, I think that's why markets will evolve and leadership will evolve. At the moment, it's the builders of AI that are getting all the attention, and so they should. And the initial users of AI, which are the tech companies.
Yeah.
So they're receiving most of the benefits initially, but then it will morph into the beneficiaries. Who are getting the productivity gains. You look at my business, for example, our business. We've got huge. Lots of back office functions, lots of people, lots of processes. That's ripe for AI to come in and really, really create efficiencies out of. So that's still to come.
Yeah.
And by the way, productivity doesn't come until you've built the factories, until you've built all that stuff. then we can start thinking about the productivity. But that's all in the future. At the moment, it's the CapEx which is driving a lot of stuff.
Yeah, well, I guess then we're coming back to dim sum, aren't we? Looking for, it's not just the risks on the downside, it's the risks on the upside, the opportunities.
I think you said dim sum as in like just my lunch. Elroy dim sum.
Yeah.
Yeah, totally. Yeah.
How do you think the institutional clients are, well, it's not how do you think, what do you see institutional clients doing at the moment as a result of these structural shifts and the things that we're talking about?
Not a lot, actually. So how shall I answer this? So sort of the three big questions that everyone's asking at the moment is, obviously Iran and oil. It's a big question mark. What should they do and what are they doing aren't necessarily the same thing. Lots of questions around US growth, particularly thinking about the left and right tail of US growth. The left tail being recession, right tail being reacceleration. A lot of focus on that because that drives a lot of thinking particularly around asset allocation. To your point earlier about concentration risk, it's basically a US thing. A lot of focus on that. And then there's a lot of focus also on this new Fed chair, Kevin Walsh, and what his reaction function will be, particularly if you get reacceleration. And so those are sort of the big AI obviously, but I think we've addressed that. As far as the US growth thing is concerned, I would put a fatter tail on the right tail of reacceleration. So would my clients.
Yeah.
The reason being is if you look at what are the core drivers of GDP growth, you got three. You got the consumer, you got government spending, and you got the corporate spend. Well, the consumer, despite all the headlines, is really resilient in the US. Not a lot of wage growth, not a lot of employment growth, but it's fairly stable, and they're still spending, and they're going to see more stimulus this year with rebates records. Now you may not get all of that back, but because there's some offset with higher oil prices, higher gasoline prices, but you'll get some. So I think the consumer's fine. The government spending is, they've just asked for another $500 billion for defence spending. That alone is 1.5% of GDP, and doesn't get much attention, but they've got to start paying back some of these tariffs that they've taken as well. It's another 150 there or thereabouts, and that means they need to probably monetize that deficit more. So that's more liquidity. So the government spending, but the real delta is, of course, corporates. You've got an AI capex super cycle. We estimate it's about $750 billion this year. Not all of that goes to the US. Some of it goes to Taiwan, obviously, but a lot does go into the US, and that's all pre-productivity, it comes with multipliers. And it's aided and abetted by incredibly generous tax breaks with the One Big Beautiful Bill. And at the margin, we've got more FDI. We've got all these reshoring initiatives that are ongoing. But the two things that people, I think, overlook as it relates to the US is who the Treasury Secretary is and what did he used to do. Scott Bessent was a hedge fund manager, and he knows all about liquidity. And he knows what liquidity can do to asset prices, but also activity. And the second thing is it's an election year. And you're going to hear a new acronym, which is Make America Affordable Again, MAR. And there's going to be a big focus on housing. Why housing? Because every new house that's built adds 3 new jobs. And it hasn't fired yet, and housing is a massive part. So I think there's going to be a big focus on that. They're going to do that through mortgage reforms. They're going to do that through they're allowing crypto for down payments on houses, which is I find fascinating. And they're going to do that by getting a dovish, or let's say a more aligned Fed chair, which Scott Bessent and Kevin Walsh used to work together. So I think and keep an eye on Kevin Walsh triggering 13.3 of the Federal Reserve Act to lend to housing markets. I think that'll be something he does. And I think he'll be very dovish as it relates to he may not cut rates, but I think holding rates into a inflating nominal growth environment is kind of the same. So I think he'll be quite dovish on rates.
Do you think markets are expecting that, or do you think that's a surprise on rates?
I think what I just said then would be considered quite contrarian.
Yeah.
I think most people view him I guess the standard thinking on Kevin Walsh is what he wants to do and what he can do could be a very different thing. It's committee based. There's 12 around the table, 9 voting consistently. He's got to get them on board. And of course, Fed forwards suggest there's as much chance of rates going up than going down. So I think what I just said would be
be a shock.
But just on that though, I mean, one of the pushbacks we get is this idea that how could you ever conceive of not raising rates when you've just said we're having a capex super cycle, and with capex presumably there'll be a commodity super cycle along with it. And I go, well, when was the last time we had a commodity super cycle? It was in the 2000s, from 2006 to 2014. Do you remember inflation being a problem then? I mean, it was for a time, but for most of the rest of that decade, it wasn't. Why not? The reason it wasn't was because we had this significant disinflationary force, namely China, entering the WTO and allowing unit labour costs to fall, and our export deflation back into the system. Those words are the words Kevin Walsh and Scott Bessent used to describe AI. AI is a significant disinflationary force, allowing central banks to run the economy hotter without risking inflation. And if that sounds like Greenspan's 90s, trust your instincts, because that's exactly the metaphor that they use to describe the environment that we're in.
I hope that answers the question that we had on how markets might react to Walsh doing that. We've got another couple of questions here, Gary, from the floor. One is, if AI is a facilitator for hypergrowth, why not take a concentrated position through a thematic ETF rather than own the whole market?
Because it might not be. I'm jokes aside. I mean, and it may not be. The beneficiaries of AI could also evolve over time. And I think whilst I'd love to be able to predict with foresight, what stock is going to be the major beneficiary, I just don't know. I feel far more comfortable in the broader index. But I think that's why you stay in the index.
Okay. AI causes groupthink when making active calls and reduces independent thought. Assuming that's our hypothesis, do you think the reliance on AI could impact price discovery?
Yeah, it could, but it's one of many things that creates and causes groupthink and herding behaviour. It's how you use it. AI is going to sort of verge to the consensus, but it's I use it. It's as much about the questioner as it is the answer that you get from AI. But I think AI is just one of many tools that creates that sort of herd type behaviour. It's really the person that's using it's got to be sort of on their wits, get their wits about them in terms of what the answer is. I think AI is really interesting. The LLMs. I've got 4 kids, and I see them, get really animated on social media, and I see it myself how these algorithms work, and they really push it to the extremes, and I get really angry, and I always get, my opposing political views is just sort of everywhere on my screen because it knows I'm going to get a reaction. These LLMs do the opposite. They kind of, every time you say something, they go, "Oh, that's really interesting. Well reasoned, well thought about." They sort of verge to the moderate. Yeah. And I wonder whether that impacts, things down the road as well. Yeah. I feel it's like a friend. It's got my best interest in heart, as 100%. Opposed to someone that's trying to, poke me in the ribs every 5 minutes.
And that's how it's being designed, right?
Yeah.
It's very deliberately. So, just in the last couple of minutes, what do you think could be the left field hand grenade that blows markets up here that no one's thinking about yet?
That no one's thinking about? Seeing we're talking AI, the thing that worries me about AI is it's not very popular. Mm-hmm. There's a big pushback, anti-AI movement in the US. I think there's something like 140 organised, well-funded anti-AI protest groups in the US. That worries me. It worries me why? Because this is exactly what happened to nuclear power in the 70s. when people started to worry about it, we got protest groups, they pushed back, no nuclear power development. All of a sudden, 70s hit, oil prices, oil embargo, the US has a lost decade, effectively. So that worries me. Midterms worry me a little bit, but actually I think the most left field thing is something far more prosaic, and that is we enter a range-bound market. Markets go sideways, and market multiples erode, like they did between 29 and 54, 68 and 82, and 2000 and 2014, where markets go sideways. That is not what I think market participants would think is likely, and therefore it poses a rather large risk. But those scenarios, historically, are not uncommon. I think that would be the biggest risk. Right. And your man Dimson, he says, reminds people that most money is not lost in war, most money is lost in peacetime.
Right. So driven by pure risk aversion, people fear of a bubble kind of causing that sideways movement.
I think a couple of characteristics need to exist. One is extreme valuations. So if you look at like the Nifty 50 peaked in the late 60s on 2x the market multiple, and then those stocks spent the next 14 years going from whatever it was, 35 times PE to 8 times PE, which is what you could have bought the market on in 1982. Whilst prices did sort of oscillated quite violently throughout. There's a great book called Active Value Investing, and it shows that if you'd bought the Dow in August of 75 and sold it in September of 82, you bought and sold for exactly the same price. But 40% of Dow stocks doubled over that period. And the question is, well, what are the characteristics of those stocks? And, I don't want to... That is something that, our factor guys can tell you what those were, but that is quite an interesting thing, and that was not what people would be anticipating.
We've got 30 seconds.
It's not my base case, by the way. I'm not forecasting that, but it's something to keep an eye on.
We've got 30 seconds. What is the key message you would leave with advisors at the moment for seeing their clients through the next 5 years of investing?
I'd be patient. I think, learn from Buffett. Be prepared. And by that I mean, preparation isn't just what we think about in terms of operational resiliency or having good cash on hand to be defensive or offensive, but thinking about how we can improve our decision-making process, going back to, assuming that not all things are bad, but some are good. And then I think the final thing is stay positive, right? And avoid those doomers. What's the saying? Bears sound smart, but it's the bulls that make money, right? Just avoid. My mother used to say, "You are the average of the 3 people you spend the most time with." Right? So just make sure they're not. Or maybe you do need a bit of perspective to have balance, but just be careful who you spend a lot of time with.
Yeah, absolutely. You heard it. Avoid the doomers.
I don't see too many doomers here, by the way. I didn't see too many doomers down there at lunchtime.
It's not a doomer kind of crowd. But thank you very much, Gary. It's been great talking to you. Thanks very much, everyone, for listening.